If your bank sat you down and said, great news, you could make payments for 50 years, barely build any equity, and still risk losing everything in a downturn, you'd probably walk out. But when they wrap the same deal in the words housing affordability, suddenly it's treated like a miracle solution. Hi, guys. Welcome back to the Baseline. Thank you so much for joining me today. So let me ask you this. Does it ever feel like every solution they bring to housing somehow ends with you working longer, paying more, and owning less? You're doing everything you were told to do. I mean, save, buy, be responsible, and yet the finish line keeps getting pushed further down the road. Now, first, it was the 30 years, then 40-year modifications, and now 50-year mortgages are being floated like they're the cavalry coming over the hill. And here's what I think is coming next. A wave of shiny new mortgage products that look like help but act like handcuffs. Longer terms, looser credit rules, teaser rates, and they will be sold as giving everyone a chance at the American dream. But if you don't see the math behind it, you're going to wake up in a 2008 remix you never actually signed up for. So today what we're going to do is we're going to break down the 50-year mortgage push and the new era of what I call a zombie loan. Zombie loans, right? Mortgages designed to live longer than the people paying them, because the stakes are huge right now. We're not talking about saving $50 on a cell phone bill. We're talking about the roof over your head, your retirement, your kids' inheritance. So get this wrong, and you don't just lose a house, you lose decades of work, and you carry that mistake like a financial shadow for the rest of your life. And here's the first thing people, or most people, are never actually told. Stretching your mortgage from 30 to 50 years barely moves your monthly payment. Going from 15 to 30 years can boost affordability, but by more than 30%. But going from 30 to 50, you're talking single digits in payment savings. And in some cases, when the rate is higher on the longer term, the 50-year mortgage can actually cost you more per month. So imagine that you're at the grocery store. You grab a gallon of milk for like $6. Then the cashier says, if you agree to pay this off slowly over 50 years, we can knock it down to $5.50. And you'd laugh. You'd say, why would I finance milk? But in housing, they're trying to do the same thing with hundreds of thousands of dollars and hoping you won't grab a calculator. And here's where it gets even darker. Mortgages are front-loaded with interest. That means for the first decade of a 50-year-old loan, you're basically renting from the bank with extra paperwork. And if home prices fall even just a little or just move sideways, you can easily end up owing more than the home is actually worth. And after 10 or 12 years of paying, it's like spending a decade on a treadmill and realizing the machine was never actually turned on. You're exhausted, you're sweaty, but you're still in the same spot. Meanwhile, we're hearing about other innovations that sound very familiar. Now, it sounds especially familiar to anyone who lived through 2008. I mean, credit score minimums being relaxed, more flexible underwriting, adjustable rate mortgages creeping back up in popularity because people are desperate for any break on their payment right now, even if it means taking on a time bomb 3 to 5 years down the road. Now, think of the housing market right now like a casino, where the house changed the rules after you sat down. First, they doubled the price of the chips. Then they told you, hey, you know what? Don't worry. We're going to extend your time at the table so you can win it all back. But what they don't tell you is the odds haven't changed. The longer you play on bad terms, the more the house is going to win. And it isn't just math, it's generational. The average first-time buyer today is around 40 years old. Now, on a 50-year mortgage, if you actually stayed in that home, you'd be staring down your final payment at 90. By the time the house is finally yours, free and clear, your grandkids might be wondering if they can afford assisted living for you and property taxes for themselves all at the same time. That's not home ownership. That's a lifetime subscription. And here's the interesting thing, right? Because this wave of ultra long mortgages doesn't disappear, or it doesn't just appear designed to make homes truly affordable. It appears designed to keep inflated homes looking manageable on paper while keeping the debt machine fed. Instead of asking, why are homes 2 or 3 times more expensive than local incomes can comfortably support? The system keeps asking, how can we stretch the loan so the payment looks just barely doable? It's like raising ticket prices on a broken down amusement park and then offering layaways so families can still get in the gate. The park hasn't improved. The rides are the same. The only thing that's changed is how long you're in debt for the privilege of just being there. Now, meanwhile, guys, the data indicates we don't have the kind of housing shortage narrative you keep hearing on TV. Inventory in many markets is back near pre-pandemic levels. The real shortage isn't houses, it's housing at prices people can actually afford with sane traditional financing. If there was a true shortage, everything would be flying off the shelf. Instead, we're seeing homes sit, prices cut, incentives, and buyers stepping back because the numbers don't pencil out. So, what do you do with all of this as any person trying to make a smart move? Well, number one, be very cautious about any products that extend your debt or your debt life beyond 30 years just to make today's prices look affordable. If you have to double the term to make the payment fit, that's not a financing problem, that's a price problem. Number two, if you've already have a mortgage, learn the power of paying extra towards your principal. Even an extra $100 a month on a 30-year loan can knock years off the term and tens of thousands off the interest. That's the kind of innovation that actually helps you instead of the bank. And number three, remember that sometimes the smartest move is to wait. Rent strategically and keep your powder dry. Because there's no shame in looking at the current menu and saying, hey, these prices, these loan terms are not designed for my long-term stability. That's not failure, that's discipline. And number four, whenever you hear about new affordability products, 50-year mortgages, super flex lending, anything that sounds too generous, ask yourself, who actually wins if this goes wrong? Because if the answer is the lender, well, you know they're going to get bailed out and the investor is going to get paid. And the homeowner is the one that gets wiped out. Then you already know you sit in that food chain. So the bottom line is this. You deserve a path to homeownership that doesn't require you to trade your entire future for a set of keys today. You deserve financing that builds equity, not just endless interest. And you deserve leaders who talk about bringing prices back in line with incomes, not just inventing new ways to stretch the pain over half a century. So let me know what you guys think. Do I have this all right? Do I have it all wrong? Put in the comment section below. I look forward to reading and replying to all your comments. And once again, guys, thank you so much for watching me here on The Baseline. Okay, cheers, everybody.